So inventory cost management strategy. So this chapter is mostly theoretical one, but we will discuss one by one most of the things here. Let's start. Inventory cost management strategies, how we can manage our inventory because inventory has a cost. So equivalent relevant data and decide on the economic order quantity. Uh, we want to evaluate relevant data and decide the economic order quantity. And we discussed this before as well, like what is an economic order quantity. Resolve conflict that arise from result of EOQ and performance models. Analyze the relevant benefit and cost of GIT just in time. The GIT means just in time alternatives. Differentiate a material requirement planning MRP strategy from and the enterprise resource planning ERP strategy of supply chain management. So there are two different approaches. One is from the demand side approach, the other one is from supply side approach. So we will discuss, evaluate and decide upon an appropriate backflush costing method. So let's start with this inventory management. What is inventory management? Inventory management is a planning, coordinating and controlling activities related to the flow of inventory into, through, and out of an organization. So this is the whole process that how we manage the inventory. Like we plan first and then we coordinate different between the different departments. And then whenever the inventory comes, we have to control it in a way that the inventory, the flow of inventory is not going to be disturbed. Uh, when we receive an inventory, it's a it's a beginning inventory, then convert it into work in process, then completed units and convert it into finished inventory. So inventories are of three different types. One is a raw material inventory, then the other one is work in process inventory, and then we have a finished goods inventory. So these are three different types of inventories we have to manage. One is a raw material or a purchases inventory, and the second one is work in process inventory, and the third one is finished goods inventory. Cost associated with the goods for sale, managing inventories to increase net income. Definitely the objective is to increase net income, requires effectively managing costs that falls into six categories. These purchasing cost, definitely when you purchase, you have a cost. Ordering cost, the in bulk, in the badges you have to order and each badge you are receiving. So number of badges is going to increase the ordering cost. Then we have a carrying cost, like if we order a inventory and we bring it and we keep it in at the warehouse. So that's what we call it as a carrying cost, like how much inventory you can carry. Then we have a stock out cost. Like if there is no inventory and the customer is demanding, so how much money we lose by not providing or by not selling our goods to the customer or a consumer. Then cost of quality, like how much we are compromising with because of the inventories running out or maintaining it. Shrinkage cost, loss of inventory as well possible. This can be because of damage, because of a theft, or because of any reason that we lost inventory. That's what we call it as a shrinkage cost. So purchasing cost of goods acquired from suppliers, including freight and transportation costs. Ordering cost of preparing and issuing purchase order, receiving and inspecting the items included in the order, matching invoices received, purchase orders, and delivery records to keep payment. Carrying costs that arise while holding inventory of goods for sale, including the opportunity cost of the investment tied up in inventory and storage, rent, insurance, obsolescence, spoilage, all these are carrying costs. Stock out costs that occur when a company runs out of a particular item for which he is as a customer demand, and the company must act quickly to meet the demand or suffer the costs of not meeting. So incur additional ordering and transportation costs to expedite the order. Expedite and order. Cost associated with goods for sale, cost of quality, COQ. The cost that results when features and the characteristics of a product or are service are not in conformance with the customer specification. These costs includes prevention, appraisal, internal failure, or external failure. So that's a cost, is the cost of quality. Shrinkage arise from theft, embezzlement, misclassification, and clerical errors. So these are all the six type of cost associated with the inventory. Economic order quantity procurement model. That's a model explains that how we can order at what level we have to place an order. The first decision in managing goods for sale is how much to order of a given product. So economic order quantity is a decision model that calculates the optimal quantity of inventory or order under a given set of assumptions. So we made some assumptions and after that we place an order. And this economic order quantity model explains us that at what level we have to order and at what and how much quantity we have to order. So what are the basic assumptions of this EOQ model? Is the same quantity is ordered at each reorder point. So we are assuming that we are ordering every time the same quantity. Demand, purchase order, lead time, ordering cost, and carrying cost are certain. That we know all these things before in hand and in a correct way. These are not estimations. Purchasing cost per unit are unaffected by the quantity ordered. No stockouts occur. Cost of quality and shrinkage are also considered if they affect ordering or carrying cost. So this is the formula or a model that we have to use in order to order economically, or we can economic order quantity. EOQ. That's under root 2 dp over C. Now D is the demand in units per specified period. Now P is the relevant ordering cost per purchase order, and C is the relevant carrying cost of one unit in stock for the time period used for D. So these all information is, if we know, we can apply this how much quantity we have to order. And this graph is representing order quantity units and total relevant cost in dollar terms. And we see that again, we are figure it out here that EOQ is 1000, where the carrying cost and annual relevant carrying cost and the store uh, relevant cost are equal, right? Storage cost or a carrying cost, right? So this is the way that we figure it out. That's economic order quantity. And if we look at the total relevant cost, which is minimum here. So total relevant cost is the total relevant order cost plus total relevant carrying cost. So total annual relevant ordering cost is number of purchase orders per year into relevant ordering cost per purchase order. And total annual relevant carrying cost is average inventory in units into annual relevant carrying cost of 1 unit. So these are the ways that we can find out different total relevant carrying or the ordering cost. The quantity level of inventory on hand that triggers a new purchase order. When to order a given product is the second decision in managing goods for sale. Reorder point, number of units sold per unit of time into purchase order lead time. So these are the two times that is going to give us that when we have to reorder. Number of units sold per unit of time, like in how many days we are selling how many units, so we can find it out per day how many we are selling. Into the lead time, the time required to refill our stock, that or inventory is that time. uh, so we see here these are the lead times, 2 weeks for each case. Excuse me. So lead time is 2 weeks, and 2 weeks 1 week is our number of units sold per week. So 1 week we are selling uh, around 750 something, and then 2 weeks we are relevant time. So we figure it out that we have to keep the inventory in units in 500. So demand is 250 DVDs package package per week. So purchase order lead time is 2 weeks. So 2 weeks into 225. So we get it 500. So safety stock, sometimes we keep a certain level of stocks as a safety stocks, and in sometimes we also have gas in our cars. We call them as a reserves. When the gas needle is at the end, we have a certain level of gas in our. There are some gas in the bikes as well. For we call it as a reserves. So safety stocks is an inventory held at all times, regardless of the quantity of inventory regarding using the EOQ model. Safety stocks is a buffer against unexpected increase in demand, uncertainty about lead time, and unavailability of stock from suppliers. So these sometimes we keep these buffer stocks, especially where we are using these, like in hospitals, we must have a buffer stock for some certain life-saving drugs. And so in the critical situations, we have to keep us this buffer stocks larger, but in a not non-critical situations, we keep the buffer stock little, or a safety stocks little. So this is a safety stock computation, how we can calculate this safety stock. So we see here there are different types of safety stock level, demand level resulting in stockouts, 600, and then stockouts in units, 2 minus 500 minus 1. So we see these are the values. Probability of stockout. So these are the probabilities of stockout. Relevant stockout cost. So these are the costs. We get it. And number of orders per year. So these are the number of orders per year. Expected output, stockout cost. So we multiply 4 with 5 and 6. So we get these values. Relevant carrying cost. So we figure it out, the relevant carrying cost, and we also get it relevant total cost. And we see here, we get it like 300 level unit is a safety stock. Now, as I mentioned, there's a concept, and nowadays it's very popular among different corporations, like just-in-time procurement. Just-in-time procurement reduce the cost of placing a purchase order because long-term purchase agreements define price and quality terms. Companies use electronic links to place purchase orders at a small fraction of cost of traditional method, and companies are purchase cards, and results in a smaller EOQ, economic order quantity. So nowadays, the companies are trying to link with the suppliers, and their system of inventory management is linked with their suppliers. And according to the software or their uh, data, when the inventory level is touching to the level when we are approaching that the order should be placed. So the automatically the system is placing an order with the supplier, and supplier getting the message and start operating to supply the required material or required goods. So in this way, we see that just in time is possible, that if because of this internet and all these technologies make it possible, then the companies can integrate with their suppliers and place the orders whenever there is a need. So in that case, we eliminate these traditional time wastage for placing an order, and this way we are reducing our EOQ. We can keep little stock or inventory, and then little inventory, and whenever the inventory level is touching that level, the order is placed automatically. So GIT, just in time strategy, and lean manufacturing. A demand pull manufacturing system that completes each element in a process just as it is needed by the first step of the process. And demand triggers each step of the production process, starting with the customer's demand for a finished product and working backwards. So this is way that when the product, when the order is placed by the customer, then all the things are triggered after that. So it's a backward process. Like normally, the process is that the goods are produced, raw material purchased, goods are produced, manufactured, and then bring it to the place where we can sell to the customers and the customer buy it. But this is a backward process. The customers place an order, then it go back to the process department, and then they go place the order for the raw material, and then they comes and then come delivered to the customer. These are very common in auto industry. Like we place orders and we have to wait for many months to get the delivery. The reason is that they were just in time uh, system strategy, just in time strategy for inventory. This method is also called as a demand pull method manufacturing system. Goals are to eliminate non-value added spoilage and scrap and reduce carrying cost and improve customer satisfaction. Because in these type of orders, the products are customized according to the requirement of the customer. So it is not possible that we can produce it first and then we can the customer is going to buy. Customer place order according to the customized requirement. Uh, so production is organized in a manufacturing cells, a grouping of all the different types of equipment used to make a given product. Workers are hired and trained to the multi-skilled cross trained. Defects are aggressively eliminated and setup time is reduced. Suppliers are selected on the basis of their ability to deliver quality material in timely manner. Eliminate relevant cost of supply chain. Now, this is the supply side, like what I said. Relevant inventory carrying cost consists of relevant incremental cost and the relevant opportunity cost of capital. And relevant incremental cost, those costs of purchasing firms that change with the quantity of inventory held. So estimate relevant cost of a supply chain. So this is a supply chain opportunity cost, relevant cost, opportunity cost of capital, the return for gone by investing capital in inventory rather than elsewhere. The cost equals the required rate of return multiplied by the unit cost that vary with the number of units purchased and are incurred at the time the units are received. Cost of a prediction error, that is also possible that we predict that the sales is going to be high, but it comes different. Three steps in determining the cost of prediction error. Compute the monetary outcomes from the best action that could be taken given the actual outcome amount of the cost input. Compute the monetary outcome from the best actions based on the incorrect amount of predicted cost input, the cost per purchase order, and compute the difference between step 1 and 2. So relevant cost of quality and timely delivery. Timely delivery of a quality product is critical for any business. Defective materials and late deliveries halt production as well as dissatisfied the customer, which is creating a bad reputation for the business. Suppliers must choose carefully and long run suppliers relationship developed. So here we see that the relevant cost, purchasing cost, um, $14 per unit into 13,000 units per year and 14.02 per units into 30. So we are using two methods here. One method is current purchasing policy and the other one is just in time purchasing policy. So these are the two prices. We want to buy 13,000 units for a year. One is 14 and the other one is 14.02. A little bit higher, very minor difference, but there is a difference. Ordering cost, how much is order? $200 per order and 13 orders per year. So we see here that ordering cost $2 per order and 130 orders per year. So we see that's a huge difference of 2060 and 260 for just in order. Opportunity carrying cost required returns on investment. 0.515 per year, 0.15 per year into $14 cost per unit into 250 units because of an average inventory per year. So we see this much is the opportunity carrying cost required return on investment. So this the other one case is two 526, it's a 525, so it's not so big difference. Uh, Other carrying cost, insurance, material handling, breakage, and so on. So 3.10 per unit per year into 250 average inventory and $3.10 per unit per year, and the average inventory is 150. So we have a difference here, 775 and 465. Stock out cost, $4 per unit into zero stock units of per year because we keep carrying, so there's no stock out. But in case of just in time, we have a stock out cost of 600. So if we add up all together, we see that annual difference in favor of GIT purchasing is 1,789. It's in thousands, but it can be in millions as well. So you see that this average inventory 1000 divided by that's the way that we calculated the average inventory and maximum demand 400 per week. So we see here that the relevant cost. So relevant benefit of GIT, how we can benefit from just-in-time system. So reduced need for material handling, warehouse and inspection leads to lower overhead cost, lower inventory level and lower carrying cost of inventory. Heightened emphasis on improving quality by eliminating the specific causes of rework, scrap and waste. Shorter manufacturing lead time. So these are the benefits that we can get from GIT. GIT purchasing, just-in-time purchasing, GIT. Reduce the cost of placing a purchase order because long-term purchasing agreement define price and quality terms. Individual purchase orders covered by those agreements require no additional negotiation regarding price or quality. Companies are using electronic links to place purchase order at a small fraction of traditional method, phone or mail. Companies are using purchase order cards. So just-in-time purchasing and supply chain analysis. Supply chain describes the flow of goods, services, and information from the initial sources of materials and services to the delivery of products to customers, both inside and outside the firm. Supply chain members share information and plan coordinate activities. Suppliers evaluations are critical to just-in-time purchasing implementation. Performance measures and tools, financial performance measures such as inventory turnover ratio, days inventory is on hand, non-financial performance measures of time, inventory, and quality such as manufacturing lead times, units produced per hour, setup time as percentage of total manufacturing time, number of defective units as a percentage of total units produced. Inventory management and material requirement planning, MRP. Material requirement planning, MRP, a push-through system that manufactures finished goods for inventory on the basis of demand forecast. Like this is what we call it as a push-through. We forecast the demand and then we produce. MRP information inputs. MRP use three information sources to determine necessary outputs at each stage of production. Demand forecasts of a final products, a bill of material detailing the materials, components, and sub-assemblies for each final product, the quantities of materials, components, and products inventories to determine the necessary output at each stage of production, MRP. So material requirement planning, MRP, takes into account lead time to purchase material and to manufacturing components and finished products, sets a master production schedule specifying quantities and timing of each item to be produced, The output of each department is pushed through the production line, whether it is needed or not. Push through may result in an accumulation of inventory. That's what we call it as a push through. Uh, Enterprise resource planning, ERP, improves internal business processes, flows of information, enabling effective inventory control system, integrated set of software modules, including accounting, distribution, manufacturing, purchasing, and human resource, integrates information into a single database in real time, highlighting interdependence, interdependencies and bottlenecks in business process. Now, there is another system what we in contrast to this push through system. That's what we call as a flashback, a backflush, backflush costing. Backflush costing omit recording some or all the journal entries relating to the stages from the purchase of direct material to the sale of finished goods, because some stages are omitted. The journal entries for subsequent stage use normal or standard cost to work backward to flush out the cost in the cycle for which journal entries were not made. Contrast to the traditional normal and standard costing system using sequential tracking, recording journal entries at each trigger point in the production process, the report on the flow of cost in the cash to cash cycle, reduce the accounting cycle to a single step initiated by the immediate payment for a finished goods. No inventory because cost flows without delay to COGS, cost of goods sold, for which payments has already been made. So journal entries for backflush costing. This table is representing that journal entries for backflush costing, and so you can go over this there is an example, journal entries and journal ledger overview for backflush costing, and journal entries for sequential tracking with two trigger points: purchasing of direct material and incurring conversion cost, and sale of finished goods. So we see that record direct material purchases. What we have to do in back flush costing: inventory control debit, accounts payable credit with the amount with which we are buying direct material. Sequential trading tracking is saying materials inventory control department control debit and accounts payable control credit, and then we write it conversion cost control debit and various accounts such as wages payable control credit. Conversion cost and various controls. So these are very same entries like in backflush as well as sequential tracking. Record production resulting in work in process, no entry required in backflush. So, but work in process control, debit, material inventory control credit, and conversion cost allocated credit. So by this way, we see that the entry. Record cost of goods sold, finished goods, that is also not recorded in backflush costing. However, in sequential, we write finished goods control debit, work in process control credit. Record cost of finished goods sold and under or over located conversion cost. So record cost of finished goods sold, cost of goods sold debit, inventory control credit, and conversion cost allocated credit. And cost of goods sold in sequential tracking, we see that the cost of goods sold debit and finished goods control credit. Record under allocated or over allocated conversion cost. So conversion cost allocated debit, cost of goods sold debit, and conversion cost control credit with them. So conversion cost allocated, so same entry is going to be passed here as well, like in the sequential tracking, like conversion cost allocated debit, cost of goods sold credit and debit, and conversion cost control credit. Uh, In this case, we have a journal entries and journal ledger overviews for a backflush costing and journal entries for sequential tracking with two trigger points: conversion of goods finished unit of product and sale of finished goods. So we see here that there is no entry for direct material purchases, but in sequential tracking, we have an entry like direct material inventory control debit, accounts payable credit. Then conversion cost incurred. So conversion cost control debit, various accounts such as wages payable are credit, and same is the case with the sequential tracking method. Production resulting in work in process, no entry in backflush costing, but work in process control, material inventory, work in process control debit, material inventory credit, as well as conversion cost allocated credit. Record cost of goods sold, finish units completed, uh, finish of goods control debit, accounts payable or conversion cost allocated credit. Uh, on the other hand, sequential, it's finished goods control and work in process. Finished goods control debit and work in process credit. Record cost of finished goods sold under or over allocated conversion cost. So in case of finished goods sold, cost of goods sold debit, finished goods control credit, and cost of goods sold debit, finished goods control credit, same entry in both the systems, costing systems. So under or over allocated conversion cost. So we again conversion cost allocated debit, cost of goods sold debit, conversion cost control credit, and same is the entry with the uh, sequential tracking. So these comparisons when I give us a good idea about what's the difference between sequential tracking system of accounting records for process costing for and what is the backflush costing system. So backflush costing does not necessarily comply with gap. So it's not comply with the gap because they are skipping some entries. However, inventory levels may be immaterial, negating the necessity for compliance. Backflush costing does not leave a good audit trail. That's again the hindsight of the backflush. The ability of the accounting system to pinpoint the uses of resources at each step of the production process. So absence of a large amount of material and work in process inventory simplifies control and management of resources, allows management to monitor operation using personal observation, computer system, and non-financial measures. Lean accounting is a costing method that support creating value for the customer by costing the entire value stream, not individual product or a department, thereby eliminating waste in the accounting process. So this is all what I want to share with you today regarding two different topics: process costing and the cost inventory management. Uh, we just discussed just in time method, also MRP, like management material requirement planning, and also we ERP. We also discuss ERP as well as Backflash. So I hope you enjoyed, and please don't. If you have a question, you can email me, and uh, or you can write it below the comments as a comment. Thank you very much. Bye bye.